It was an eventful first half of the year, and after the volatility of the early couple of months, things calmed down a little bit. But it's fair to say that the uncertainties we saw in the first half are still very much with us. Three that I'd like to focus on today are politics, trade, and monetary policy. Let's start with trade. It's fair to say that the rhetoric has been ratcheted up over the last 6 or 8 weeks, along with an increase in the actual number of goods and services that are impacted by new protectionist measures. So far, it's too soon to say that this will have a material impact on global growth, but we do think it's beginning to have an impact on sentiment, both amongst consumers and among businesses. We've begun to see some sort of an impact in emerging markets, which are generally speaking more trade-oriented, although it's also true to say that the relative weakness of the Chinese equity market has some domestic components to it as well, notably around credit growth. Still, it's a real area of focus for us in the next few months. The US administration would probably argue that this is simply part of a negotiating strategy on their part. However, what we continue to see is no side is really ready to back down, and there appears to be a willingness potentially to take on some economic pain to try and win something that we would argue is not really winnable. Political uncertainty is likely to be a feature of the second half of this year, as it was in the first. When we look around the world, we see a number of areas of uncertainty. In Germany, with the debate over immigration; in Italy, with the coalition government still formulating its policies; in the UK over Brexit; in the US over a broad range of issues; and even further afield in a country like Mexico, where a new left-wing president has been elected, and the policy mix there over the next couple of years may look rather different than what we've seen in the past. Markets tend to look through policy uncertainty when economic growth is relatively robust. And so far, growth has remained relatively good. But what we've seen is that versus expectations, some of the data has come in a little bit weaker. In Europe over the last few months, and in the US more recently. So an environment where growth is still good, but maybe not quite as good as we would have hoped, policy uncertainty can have more of an impact. And as we think about how we position portfolios for the second half of this year, that becomes a more important consideration. We've talked in the past how global central banks are keen to raise interest rates from the very low levels that we've seen in recent years. In this case, the Bank of England has a particular challenge. Economic growth remains relatively weak. Inflation, which spiked after the Brexit vote, has been coming down. And household balance sheets are already quite stretched. Nonetheless, financial market expectations for a rate hike in August have been rising. I'm not sure that the central bank will hike in August, but if they do, I don't think that it'll be the start of a protracted monetary policy tightening. I think that the UK economy remains too weak to really be able to sustain an extended period of interest rate hikes, and the central bank will move very cautiously in terms of how quickly it tightens monetary policy.